Hi, everyone. This is Jason Burek of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. I started following his work, I think, in 2009, before he even had his own website. He was writing these great articles over on Financial Sense. I loved reading them as soon as they came out. He's now started the popular SRS Rocco Report. Steve San Angelo, thank you for joining me again.
Jason, it's great to be here.
Now, Steve, you cover the energy industry and oil, so peak oil, and you also cover the miners of gold and silver. We'll get to the gold and silver miners and gold and silver markets later in the interview. I want to talk about the oil market first because there seems to be so much peril going on. You just put out a new piece on your website about collapse of U.S. shale oil production. It seems to me these shale oil producers, they have kept their production way too high. Have they been using more debt to buy themselves time?
Yes, and I think they've been using debt for several years. Art Berman, was an oil geologist, and now he's got his own website called artberman.com, and he's been putting out some great articles and cash flow analysis. And even with the price of oil at $100, very few of the shale oil drillers were making a positive cash flow, and even worse, the shale gas players were worse off. And so even at 100 or 90, there was very little positive cash flow. And so what was happening was basically the drillers were on a treadmill. They're using capital expenditures to add more wells to grow production, but they weren't making any money. Well, now that the price of oil is, U.S. oil is like $37, $38, we know most of the shale companies aren't getting that. They're getting 20. Some might be getting $19, $22 because of the expensive cost to ship that oil. They're not using pipelines. They're using more railroad or truck. So that's very expensive to ship that way. And so, unfortunately, they're not getting that $38 right now. They're getting much less than that. So this really impacts their bottom line. And they are still sitting on a lot of debt. I mean, serious debt. And the only reason why this continues to work is because they still are able to get capital. And it amazes me why people would throw money at a company that is not making really positive cash flow and has a lot of debt. So this will continue to go on. And I think if we don't see higher prices, we may see lower prices for the next couple of months. And if Iran starts bringing on more oil, if some of these, like the strategic reserve in China, they've extended their reserve, they've built a larger reserve. Once they fill it up, if we get to where a lot of the inventory is becoming full, then where is the oil going to go? And so I think we could see even lower prices. I've seen estimates of in the 20s. Gosh, we haven't seen that for more than a decade. So I don't really see a big bounce back like we had in 2008 when oil went from 140, fell to 35, and then it shot back up into the 70s rather quickly. I think we could just kind of mull around unless there is a black swan or a wild card where either something gets taken offline, like Saudi Arabia, they decide to do a cut, or something happens, there's a war in the Middle East and production, then we could see a big spike. But if we don't have those two events and we have market as normal, I think we could see $40, $50 oil for a year. So this could be devastating for the U.S. shale oil industry.
Yeah, OPEC couldn't agree on a production cut, and like you said, Iran actually said, because of Western sanctions, they want to bring on 1 million barrels per day. That doesn't make a lot of sense to me. I guess, obviously, a lot of these oil-producing countries, especially the OPEC ones, a lot of them are broke. Even the IMF said that Saudi Arabia could be broke in 5 years because they're going through their foreign exchange reserves, their savings from all their oil profits accumulated over the decades. They've been spending them like crazy to maintain their budget. I just don't see anything sustainable in the oil market, though. Like you said, there's been way too much debt that's been used to drill. I think one of the main things I've heard from oil people that I've talked to in the past, these are the oil guys, that have been in the industry decades, not the ones maybe who just started their own shale company a couple of years ago, raised some money, and have been drilling. But the old adage used to be you don't drill on debt. But yet in the shale oil industry, That seems to be exactly what has happened, and it's just perplexing that the production, the amount of oil production in the shale industry is still so high. I've been waiting for big production cuts for a while, and also bankruptcies, but we haven't. We've had, I guess, smaller and medium-sized oil companies in the U.S. go bankrupt. I think there's been over 30, but they've been very small. So we haven't had, that really major large firm yet, or those couple large firms go bust, and then, it starts to panic, and then other producers start to turn off, production, and it creates a cycle like that where we have, a spike low and a panic bottom.
Well, I agree, and I think this kind of like the system is being propped up by this extra capital that's coming in. And they're basically just using this capital to continue enough wells so we don't have a huge collapse. But now, according to the EIA's most recent drilling productivity report that comes out once a month, they do estimates of what they think the top shale fields are doing in the U.S. Now, according to their estimates, and they forecast that in January next year, they forecast that we're going to lose about 116,000 barrels a day off of the top shale oil producers. Now, they have, according to their data, and again, it is estimates, but we are starting to see some of the actual production data come through from North Dakota Department of Resources, as well as Texas, and the EIA's weekly figures, that we are seeing declines now. And I think they will, once we start to see them towards the end of this year and beginning of next year, they'll pick up. But according to the newest drilling productivity report, they show Texas Eagle Ford down 30% by January, from its peak about March. I think they put them at 1.7 million barrels a day, and they forecast they'll be down to 1.2 in January. Will that be that much when the production figures come out? I don't know, but if it is, that's pretty big. I would call that a collapse. That's a 30% decline in less than a year. So I think if we continue to see low prices, Jason, I think we will finally start to see these production declines fall quicker, and we could see the shale production. We could see months of falling 200,000 barrels a day. So it'll be interesting to see once we do get bankruptcies, or we do get companies that are just going into bankruptcy. I think once that word comes out, bankruptcy, on a larger shale producer, then the capital might start to dry up as the market realizes it's just a Ponzi scheme. And again, shale oil, as Art Berman puts it, it's a retirement party. This is the reason why we're drilling shale, because that's all we have left. And it's very expensive oil. The energy return on invested of shale oil is about 5 to 1. It takes 1 barrel of energy to produce 5 for the market. Now you compare that to 101 during the 1930s, when they were finding oil in California and Texas and in Oklahoma. It was like coming out in rivers. So it was 101 back then. 1970, it fell to about 30 to 1, and we're trying to, extract shale at 5 to 1. Unfortunately, there's not enough profitable barrels there to maintain this highly complex infrastructure in the U.S. I think we need something like Charles Hall says 12 to 1 north. So we need a lot of debt to bring out this inferior energy return on invested oil. That's why it's very expensive, and that's why it's not sustainable. So I think conditions are going to get very interesting going forward, and I see a lot of red. I see a huge production decline. As I mentioned in my articles, I think we will see 30 to 40% decline of U.S. production total by 2025, and we could see 60 to 75% gone by 2025. So that's a whole different world. How we're going to run the U.S. Suburban economy on that little oil. It'll be interesting to see how we can do that.
Steve, I think we might even see that sooner if we start to see, the bankruptcies create create a vicious cycle where, like you said, more than one firm starts to go bankrupt. I know the Bakken shale oil producers, they're higher cost producers, I think, than the Eagle Ford ones. There's more transportation costs. There's more drilling and the costs in the area are much higher. We have a couple listeners to our show who've actually lived up in the Bakken, so I've heard stories about the prices for rent and food and things like that. They're insanely high. But I was looking over the weekend, last weekend, at Whiting Petroleum and also Continental Resources. I was reading articles up on them and looking at their balance sheet. Whiting Petroleum still has a lot of debt, and yet, they're talking about how they can survive going forward. They're talking about how they've lowered costs, but yet they still need $50 a barrel oil to be cash flow positive, to generate free cash flow to pay off their debt. And then they're talking about, they can buy themselves time by they haven't supposedly they've used other forms of debt, but now they're talking about drawing on their revolving credit facility to buy themselves more time, which is taking on even more debt. I guess basically, they've already spent a lot of debt, and now, they're going to go to the credit card. They're going to go to the credit cards now to buy themselves even more time, hoping for a higher oil price. So it's a bad business model when you have a lot of debt and you're hoping and praying for a higher oil price.
I read a lot of different blogs, and some of these blogs, like Ron Patterson's Peak Oil Barrel, he was in the industry. A lot of guys who comment there are actually either retired or they're still in the industry. And this one fella, he said that there's this thing, I believe it's an ESP pump, electronic submersible pump, and now they've been inputting a lot of these in these shale wells, in these horizontal wells recently. He thinks the number could be 30%. Now, what that does is there's this idea that there's been an increase of efficiency because they're doing multiple pad drilling off of one pad, multiple well drilling off of one pad. But he thinks that's not really the case, and it may be more of what they're doing is they're pulling out more oil using these pumps. So it gives the illusion that there's more efficiency, but the problem is that these wells will deplete even faster. So you're going to have a real fall off. And again, I'm not quite sure what percentage of the new wells the last few years have been adding these pumps, but what it does is it pulls forward quicker the production, so the decline rates going on will be even faster. So again, this is basically the retirement of the U.S. energy industry. While we still have oil in the ground to produce, a lot of it is not really economical, or the public really can't afford it. And I think we're starting to understand that. And we spoke before the interview how debt needs to be added to the system to allow expensive oil to come on. And the more debt you add, then you have to lower interest rates. If you're a federal government and you got $18 trillion, so the government's been adding debt to keep wage earners buying things they really can't afford. And when the debt gets to be too high, well, you can't service that debt. I mean, can you imagine if the U.S. government had to pay a 4 or 5% interest rate on or service on their debt? It would be $1 trillion plus. It could even be $1.5 trillion. I mean, that's just unsustainable. So we had to go to zero interest rates, and now we may even go to negative because that's the next step before the whole thing falls apart. So I don't think there is really any good analysis to how to really forecast how things unfold, and which is why I tend to like to be in the precious metals, because they always are the go-to safe asset. They are the best insurance going forward.
I think gold and silver are very good. Although, a lot of people tried to time the market in 2011. They chased the price higher. They made one or two large purchases near the top instead of buying a little bit every month or a little bit, every couple months or something like that. I guess it's just human nature. But you brought up a very interesting point about interest rates and debt. We were talking about this also before the show. Besides in the oil market, I think, the global economy needs a Goldilocks oil price where it can't be too low, where a lot of the commodity producing countries produce oil, and then they can't afford, they can't meet the production costs and generate positive cash flow, and then they lose jobs if the oil price is too low. And if the oil price is too high, then consumers can't afford it globally. So there has to be a sweet spot for oil prices. What that sweet spot is debatable, but if the oil price is too high or too low, it basically wrecks the global economy, in my opinion. But in terms of global debt, like you said, I think this all goes back to Keynesian economics. We were talking about this before the show. Keynes wrote in his general theory, he said when the economy is bad, the interest rate should be brought to zero. We have a lot of neo-Keynesians and people on Wall Street and academic Keynesians now saying, oh, Keynes never said that. Keynes wouldn't have advocated any of the policies going on now, blah, blah, blah. He would have allowed to let firms fail. No, that's not what he said. If you go back and read the 3 Austrian school books that go through almost line by line Keynes's general theory, whether that's Rothbard's Keynes the Man or Henry Hazlitt's Failure of the New Economics, or the recent one I just read, I highly recommend all of our listeners read this one, is Hunter Lewis's Where Keynes Went Wrong. That was an absolutely excellent book going through the general theory and talking about all Keynes's screw-ups. So I think you're exactly right, Steve, that where, you have Japan, you have the United States, you have Europe, you even have China doing this now, where all these major developed economies are all trying to manipulate their interest rates lower, and that's just to buy themselves, another couple months or 6 months or something like that. They're not even thinking about the long term because they're just trying to delay a crash or a total collapse or something like that, another couple months or 6 months.
Yeah, and I think the biggest problem with a lot of the monetary science, and I even include the Austrian school, which I think is the best school of understanding money, real money, and how money works in the economy, is that if we look at most of the Keynesians and all that, everything's great if you just exclude energy. I mean, even I think to the Austrians, it's a certain. I've had some debates about the energy return on invested with some of the Austrian school folks, and I think we can print money forever. We can lower interest rates, and we can continue, talking out of both sides of our mouth as the Fed does, for quite a long time. And people think this can go on for like another 100 years. Well, I think U.S. oil production is going to collapse, and even with high oil prices, several energy analysts were forecasting a peak and decline of the Bakken and the Eagle Ford around 2016, 2017. So if we had $100 oil, there's only so many places you can drill. That's it. There's only so many drilling locations in these areas. And if you look at the amount of wells that they've added, and if you look at I've got this on my last article, if you look at the amount of wells they've drilled, it almost corresponds to their production increase. So we were going to peak regardless of the price of oil. This lower price is really basically taken the curtain away and shown the naked system as it really is, and it's a Ponzi scheme. So the thing is, I think the reason why I like the energy situation is because gold and silver are stores of economic energy, and it takes a certain amount of energy to produce gold and silver. And so when you have all these financial assets, Jason, and I think this is the problem. Someone said, Steve, I wrote an article showing how the price of gold and silver, how the price of gold has corresponded to the movement of the price of oil. And they're very, very close. So as the price of oil shot up from $1.50 in 1971 to $35 in 1980, the price of gold shot up, and so did the price of silver. We saw the same thing from 2004 to 2011. Same thing. This is no technical analysis could forecast this. This was based upon the inflation in the price of energy. Well, now that the price of oil has fallen to $37, and I think Brent's right around 40, well, people are starting to worry, then it costs less to produce gold and silver, so that means gold and silver may not go up because the price of oil is down here. Well, that's if you view and gauge the value of gold and silver as a commodity. It's cost of production and then how much is consumed. supply and demand. Well, I don't look at gold and silver in the future in those terms. I look at it as a store of value. Now, right now, and I'm going on a bit here, and I'll conclude by saying this. Gold and silver are competing with the hundreds of trillions of paper energy IOUs, which they're bonds, stocks, retirement accounts, corporate bonds, insurance funds, mutual funds, all that garbage is an IOU. And the only way it can be paid back is if you burn energy next quarter, next year. And you can't just burn energy. You got to burn more energy because, you see, Jason, people don't realize interest rates. Well, where does interest come from? Well, I get 4% in my bank account, or I used to. But where does that 4% come from? It's not a magician. Isn't it the Wizard of Oz just took 4% and said, here, I'm going to pay you 4%. That came from the increase of the energy supply. Growing energy supply has allowed us to increase our interest rates or keep our interest rates at a normal, let's say a normalized number. Well, now that we peaked in oil production, or cheap oil production, we can't raise rates. We don't have a growing energy supply. We have a growing expensive energy supply that it's only possible with a lot of debt. So interest rates can't really rise because we don't have a growing energy supply. That's where the interest comes from. So now the problem is, how is this all going to fall apart? Well, I think where it's going to fall apart are those $200+ trillion worth of financial assets that are based upon net present value. So when we start to see their values start to decline because the energy production's falling, the economy's falling apart, other investors are going to start going into gold and silver. And so, again, unfortunately, as you said, some investors got into gold and silver early. You can't really, but it's better to be in early than late when you get your insurance. If your house burns down, you can't get the insurance. So I just wanted to say that I think going forward, all these financial assets are going to be in severe stress as we start seeing oil production starting to decline, and it could collapse in certain places in certain areas.
Yeah, another point there why a lot of the mainstream people, obviously they're not gold or silver bugs. They don't know a lot about Austrian school economics, but the mainstream people, people who are business people are looking close to retirement. When I talk to them, a lot of them are looking desperate, even chasing for yield, for extra income to supplement either a job loss or maybe their kids have moved back into the basement and they can only find part-time jobs and they want to support them at least somewhat. So people are desperate for income, and owning physical metal, gold and silver, it's insurance, it's wealth preservation. It doesn't produce extra income. So we have an environment now where people are taking ridiculous extra risk to get a little bit extra yield, dividend yield, or we had these master limited partnerships, which the business model for those worked very well at a higher oil price. They were able to generate a lot of cash flow and pay out a big distribution. And now we see, Kinder Morgan, which was one of the better pipeline ones, they've cut their dividend. I don't think they've completely eliminated it yet. I can check on that later. But, we have other companies that did pay out higher dividends, like Freeport-McMoRan, the copper producer. They completely, I think, eliminated their dividend or cut it this week. So we're starting to see people that used to rely on income from certain companies, those things are being cut. And as those asset prices fall, in whether it's bonds or stocks, and as those dividend income streams start to be cut and things like that, gold and silver are going to offer a better alternative because people are going to say, you know what, I'm not being paid an income to this, I may as well go to gold and silver. Now, you brought up something interesting about cheap oil. I want to talk about the gold and silver miners right now. True or false for this question, if gold and silver weren't higher in other currencies and the oil price wasn't so low, more than half of the primary gold and silver miners would be bankrupt already.
Yes, probably. And I just looked at this. I usually do a quarter estimated break even on my top 12 primary silver miners. And actually, in the last 2 quarters, I've kind of put it to the side. But I went and looked at their financial statements, and of the 12 that I look at, only 3 made a net income or adjusted net income, and it wasn't that great. I think Tahoe had the highest, but they're an exception to the rule because they have such a high ore grade, and they can produce silver, and they produce a lot of it, like almost 5 million a quarter. So they have a very low cost basis, actually the lowest I see in the whole industry. But again, 3 out of 12 made a little bit of money this last quarter. The rest of them didn't. And if I add all their adjusted income up, it was a combined loss of 66 million. And I go by adjusted because there's a lot of stuff in there, either impairments that, even though it is a loss, it's not really mining a loss, how much it costs to produce the metal that quarter. So I think they lost a dollar. The industry lost $1 or more, maybe $1.50 an ounce last quarter. So they're just barely making it. But I will tell you this, though. I do think the silver miners, when we see a situation turn around, I think the miners to invest in the future, the only miners I would consider investing in the future are probably the silver miners because, A, it takes very little energy compared to base metal or gold production. I think it takes it takes 50 times more diesel to produce an ounce of gold than it does an ounce of silver. And then the base metal, they just move a lot of ore to produce copper, lead, zinc, which I think we're not going to need as much going forward, especially during peak oil. If you have peak oil, when you have peak oil, GDP falls. And GDP falls, we need less copper and zinc and lead and iron and whatever. So I see a peak in silver production stemming from a peak in base metal mining. But that being said, who knows how things go forward, what's going to happen with the price of silver. But if we look at gold, heck, the commercials now are they are net long gold. First time, according to Terry Ferguson at TF Metal Report, this is the first time they've been net gold in their commercial position since 1974. So I think we're going to see a turnaround in the precious metals, but I don't know if we'll see a turnaround in the base metals and the miners. But that being said, I've always said that I think the best thing to be is in the physical metal, but I don't see a problem if you're going to invest in the future. And we don't know if this is the bottom yet, but I do think the primary miners will survive longer, even than the gold miners, because of energy supply. I think the primary silver miners will be the best bet going forward. And of course, that's just my opinion.
Well, when I look at the miners, I looked at the balance sheets of Pan American Silver and also Coeur d'Alene recently, and Pan American Silver had all-in sustaining costs, which are obviously a better mark of costs. They're a better accurate measure of costs, than cash costs. Cash costs leave out so many things. But even Pan American Silver, and they've done a good job, I guess, cutting costs the last 24 months or so. It took them a while to start cutting costs, but now they're committed to it. A lot of the miners are. But they have $14.50 all-in sustaining costs, which the number looks low. Obviously, that was the number. They were somewhat profitable until the silver price started falling further. But, 3 out of their 7 mines, Steve, were still running at big losses. So when I looked at the individual mines, there was 3 of the mines that were still running. They didn't want to shut them down, and they were producing at $17, $16, $15 an ounce. And Coeur d'Alene, which produces a lot of silver down in Mexico, their all-in sustaining costs, they need to 16 or 17 silver to break even. So these companies, it seems to me, I use this analogy on podcasts, and it's really sad. I feel bad for the miners. I think eventually this is going to lead to really bad supply problems at some point down the line, because I don't know how much longer the miners can keep chasing the manipulated paper price lower and survive. But it seems to me that the miners are basically, the gold and silver miners are basically like Wile E. Coyote, and they're chasing this manipulated paper gold and silver price, which is like the Roadrunner, and we all know what happens to Wile E. Coyote, right? Every time he chases the Roadrunner, he gets close and he misses the Roadrunner, and then, he runs off the cliff, or the anvil hits him, or, he has some catastrophic accident. So that's what I feel with the miners, but I think at some point, the miners cannot cut costs anymore. From speaking with, geologists and reading conference calls and stuff, the miners have basically high-graded. I guess they've destroyed their long-term economic mine plans for so many of these mines. And the mines were brought on after, 2008, 2009, after the crisis. And, the mine plan said, we cannot mine all of our high grade in these couple years, because then we're going to raise our costs, over the 5, 7, 10 years, 15 years mine plan of the mine. And yet the miners keep increasing the high grade that they're mining to survive. So I don't think any of this is sustainable in the long term. Something's going to have to give very soon.
Yeah, no, I agree. I do agree. Matter of fact, there's only a few of those 12 I would be serious on investing in. Of course, if we have a reset, the silver price does move up, and I want to talk about that here in a second. But of course, any stock that had silver to it would go bonkers. But again, to me, this is, if you're a person of modest investment, this is not where you put a lot of your money. This is a gamble. And so investing in the mining industry to me is a gamble, but I don't see, if you've got your other physical metals, if you have your other investments, I don't see a small investment into some of these stocks as unwise. So, but you see, what's happened, what's changed, and I wrote an article called The Death of Paper, Gold, and Silver, Jason, and from 2006 to 2010, we saw a build of 61 million ounces in global gold ETFs. Well, about double that amount went into physical bar and coin demand. So about 123 million ounces. Well, this changed. When the price of gold peaked in 2011, something changed. Well, from 2011 to 2015, we actually saw a net 21 million ounce decline of the global ETFs, and most of it was the GLD. And there's been speculation, and that was used to help, fill in the holes or fill in the demand from Asia and China and whatnot. And I think that's probably pretty much accurate. Well, here's the stunning thing. If we thought 123 million ounces of physical bar and coin demand from 2006 to 2010 was a lot, well, it went to 209 million ounces between 2011 and 15, while the paper gold ETFs saw a net decline. Now, let me just say about silver, and silver is even more drastic. From 2006 to 2010, we had about a 570 million ounce cumulative net build of silver global ETFs, and we had about a 530 million ounce of silver bar and coin demand. So there was a little bit more that went into the silver ETFs. After 2011, when silver peaked in 49, we only saw 18 million ounces of silver go into the global silver ETFs. And people would say, well, the price is falling. Investors don't want to go into a falling price of a silver, so that's why we didn't see a build. Well, why did we get 994 million ounces, almost a billion ounces of physical bar and coin demand? I mean, so it's almost astronomical, the difference. So people would say, the mainstream analysts would say, well, we're not seeing a build in the silver ETFs because the price is falling, which makes sense. Well, why did the world add a billion ounces of silver bar and coin demand? So I think what's happened is more and more investors, and when we saw the shortage of silver product demand during the spike from June to September this year, which was 3 times, silver eagle sales were 18.6 million from June to September. Well, we had a shortage back in 2008, but from June to September 2008, it was only 6.1 million. So we've had 3 times more retail demand this year, and we still had a shortage. That just tells you how much more demand there is, even at low prices. So I think what's happening, I talked to some dealers back at that point in time, this last 4 months during that shortage, not only mom and pop folks buying a couple of silver rounds, maybe 10, but the wealthy who were making 6 and 7 figure purchases of precious metals, 80% were going into silver. And why wouldn't they buy 1,000 ounce bars? And here's the thing: they weren't buying 1,000 ounce bars. Some weren't even buying 100-ounce bars. They were buying the official coins. And so now I hear they're buying more bars. But this is what's happened. People who are waking up, even the wealthy, and more wealthy are waking up. It doesn't take a lot of them. They've been buying a lot of silver. So I think the paper market for gold and silver is dying, and we're starting to see it in the demand for silver ETF and gold ETF. And so as time goes on and we start seeing more problems with debt, more companies going under, and negative interest rates, like you said, people were investing in stocks because they got a dividend, even though they didn't like the stock price. Well, I still got a 5, 6, 8% dividend. Or they have their money in an account where at least they have it in there. But what if you go negative interest rates? Well, the whole notion then of holding gold and silver because you don't earn anything goes out the window because you're not getting any dividends now, and they're taking money from holding your money in a bank account. So pretty soon, as we start seeing more of this friction, more these wealthy investors have their dividends take away and see stock prices falling and then going into maybe negative interest rates, more and more of them are waking up and saying, "The hell with this." You know, even though you don't make a return on gold and silver, it's at least a store of value where paper money is not, or a stock price that collapses and doesn't give you a dividend. That's not a store of value either. And if you look at some of these stock prices and some of these shares, they've fallen 20, 30, 40% in just the last couple of months. So I think we're going to see a whole different market going forward. And even though it's been frustrating for precious metal investors since 2011 to deal with this ongoing falling paper price, I don't see it as something that's going to continue for much longer.
I completely agree. I don't think any of this is sustainable at all. You know, maybe we go a little bit lower, maybe for another 6 months or a year or something like that. But even then, it's on borrowed time for many of these miners. Now, with people who just look at the chart, Steve, at the gold and silver charts and things like that, you know, I hear, oh, silver is almost definitely going to $9, and gold's going way below 1,000 and things like that. Well, here's the thing: if we go below there for a long period of time, a lot of these mines, like I said, were brought online at much higher prices, and the miners have figured out clever ways, I guess, to delay bankruptcy by either selling a little bit more shares to raise cash or taking on a little bit more debt, or from an operational perspective, figuring out ways to cut costs on selling general and administrative expenses, or, you know, switching to high grades at the mine. But there's only so many different ways out of all these numbers of things that they can cut costs. They cannot cut costs forever because they're constrained. You know, they have to spend a certain amount of diesel oil and things like that to pull the metal out of the ground, to separate the ore. They need to spend on chemicals, you know, for separation from the different ores and things like that. So there's certain real world costs that just after a certain point, they just cannot be cut. So I don't think the people who look at charts understand this. I actually, from speaking to them, most of them don't even care. You know, they just care whatever the chart says. But at some point, we're going to run into a real world constraints where, you know, the mines have cut their workers. The workers won't take any more pay cuts, or they're going to demand higher wages, or the mines are just going to get shut down. Now, obviously, a couple of years ago, I thought the mines would start to shut, as some of them would, and we've had a few here or there. We haven't had massive shutdowns of mines yet. The miners have, I guess, been clever enough to figure out how to keep the mines running one way or another. But, you know, this is not sustainable where they can figure out how to infinitely cut costs and still survive, especially when many of these miners are not cash flow positive and they have debt.
No, I do agree. And what's interesting, when we had the Depression, the 1929 to 1933 Depression, the silver production just plummeted globally in the U.S. And I don't have the exact figures on the top of my head, but I think around U.S. silver production fell like 70% in 4 years. I mean, that's a collapse. Global silver production, I think, fell maybe 55, 60%. I actually have a chart, but I don't have it right in front of me. Well, when we had that crash of the housing market, and when just about the entire U.S. investment banking system went belly up, and we had that recession, we didn't see any fall in silver production. It just kept growing. And I think this year it's going to be less. I had an email exchange with some different folks, and they produce official data for metal production. And actually, one company, I looked at their data, and they were using data that was incorrect. And I said, your Mexican data, you're showing growth in the first 8 months compared to last year. According to the Mexican INEGI, they're showing a 5% decline. And they responded to me and said, oh, we're sorry, we didn't realize that they had updated their figures. And so I was quite surprised how an organization that charges 2,775 euros a year for their monthly production figures didn't update or revise their numbers. Anyhow, I do think we're going to see a decline in silver production this year compared to last year. However, if we see a real ungluing of the economy here and oil prices continuing to fall, I don't think they'll fall that much more, but you're right. I think we're going to start seeing copper mines being shut down. So production will come off. But I don't think this is something, 3-4 years from now, like the Depression, after 1929, when the prices fell, and silver fell, I think, by 50-60% its value fell by 1933. Well, by 1937, or 1938, the price of silver was higher than it was in 29, and we were producing more silver than ever. I don't see that this time. Peak oil is going to destroy the ability for us to get back up to where we were. So I think once we start seeing declines, Jason, I think they're going to be permanent. And how things unfold going forward are going to be interesting. So the only saving grace for the primary miners, the silver miners, is that silver and gold are the go-to assets. And so if they can survive, and there's only a few companies I would invest in. Core is one I would not, unfortunately, because they have such a high cost structure. I think they could be one that they would have a lot of trouble going forward. But there are several that are still doing okay, even at this price. And those are the ones you would want to focus on. But I don't know. It's good to speculate about it, Jason. But I think what I heard from one of my dealers, he says that the wealthy are ready to pull a trigger if gold and silver get to a certain price, low. So I think if we start seeing lower prices, you're going to see a lot more buying, and the premiums may skyrocket again. So it's going to be. I think if silver and gold prices start going lower than they were just a few months ago, I think you're going to start seeing a lot of buying coming in again. And it's much different than copper and zinc and lead. No, China is, from what I hear, China is actually dumping on the global market some of their large inventories of their base metals. So it's a big difference between the two markets.
Yeah, it's going to be very, very interesting going forward in the gold and silver markets. It's just really amazing that the gold and silver price has been this low for this long, and the miners have survived. In wrapping up this interview, Steve, please tell our listeners where they can find more of your work.
All right, Jason, if you go to the srsroccoreport.com, I put out 2-3 articles a week talking about how energy and precious metals, the mining industry, and the overall economy. I had a silver chart report I put out earlier in the middle of last year, or this year, and that's a paid report, and it's on 5 different aspects of the silver market and industry, and I'm working on another one now. It's fascinating, the data I'm coming across, how much silver was supplemented into the market since the 1960s. First, of course, it was U.S. silver. The Treasury, they supplemented the market of 1 billion plus ounces. And then we had some coming from Asia and India. And then over the last, let's say, 15 years, a lot of it came from China, Russia, and India. Well, that's all gone now. 2014 was a big fat zero. No government sold any silver. And because the reason why is a lot of it has been depleted. And so there's really no silver stocks available. So I see this ongoing situation. It's been a 5-decade-long transformation of taking real money, silver, getting it into the market to help supplement the, let's say, the industrial monster that was devouring 60% of silver, and then a lot of that's gone. You can't get that back. And so now we've been devouring all this silver, this monetary silver, and some of it has gone into investment, and it's being held in investment demand. And there's a good bit out there. There's a couple billion ounces maybe. But what's interesting, when we had high gold prices, a lot of gold jewelry, especially U.S. citizens, pawned it off because they needed money in 2009 and 2010. No one's pawning silver jewelry. It's just not feasible. You get a couple of rings you bought for I don't know how much. It's not worth your time to go pawn it off for $5 or $15. So silver jewelry, which was a good percentage of jewelry demand over the past 50 years, a lot of that's never going to be recycled. So I think there's actually less available silver for the market. And I've read articles about this than there's actual gold. So to me, silver is, and I keep talking about silver, but I think silver is one of the most undervalued assets, even though it doesn't look like it now. But I call it's going to be Bear Stearns in reverse, where Bear Stearns went from 92 to 2, silver will do the exact opposite when the reality and the fundamentals kick in. So it's been a pleasure chatting with you.
Yeah, I always enjoy my discussions with you, and I actually had forgotten my last point there before I was asked you to talk about your website, but I just remembered it right now. You were talking about how the silver production collapsed, after the 29 crash. Well, one of the reasons it went up was, I think, like silver miners and other mining unions, because to save jobs, they lobbied FDR very hard, and he agreed to subsidize the silver price way above the market price. So the U.S. government was stockpiling silver back then and paying, the miners to stay in business. That created unintended consequences. China was on a silver standard back then, and silver started rapidly leaving China, so their money supply started to act really weird. And then, China went to paper money because they didn't have enough silver because the silver left the country, and then that caused hyperinflation. So, it's again, politicians screwing with the market and things like that. We have that right now with the covert and overt manipulations of the gold and silver markets, although now it's more covert because, back then in the 60s, we had the London Gold Pool. That was overt. Now it's more covert with the paper futures contracts and things like that.
No, you're exactly correct. That did happen. As a matter of fact, I've been looking at the old USGS reports in the silver market, and up until 70s, early 60s and 70s, U.S. government was paying companies for exploration for silver. So yes, the price of silver was held up by the government, and they bought the silver, and the U.S. government also bought silver from around the world. But again, a lot of silver that came on the market after the Depression and in the 40s and then onward, a lot of that silver was from base metal mining. And so I've heard some analysts say that primary mining was the highest until recently, and it really wasn't. Even during the Roman times, silver was found with lead, and they drank out of lead goblets and they used lead for their water. I mean, that was silly. They didn't realize it. But when you mine lead, you get a lot of silver. And so, or zinc, but mostly, lead has a lot of silver in it, mixed in it. So, and copper as well. So most of the silver that was mined, I'm not saying most of it, let's say at least in lead, zinc, and copper, and gold, I would say it was still 50, 60% back then in the 1930s and 40s. Looking at the data, a lot of it was base metal and gold production byproduct. So, but again, the government they were propping up silver prices, and they continued to do that until the 1960s when they realized they could no longer do it, and that's when we had more free market silver.
Yeah, and I think a lot of those base metal miners now that the copper price has collapsed and zinc price and so many of these other base metals have collapsed that produce silver as a byproduct, a lot of them haven't sold off, those silver streams to Silver Wheaton or anything like that. I think a lot of those base metal mines, they were much higher cost and they needed a higher base metal price. They bet on China continuing to grow. Those things are going to shut down. So I've interviewed Eric Sprott recently about that, and I've talked about this at length too. I think there is strong demand, like you talked about in the interview, for physical gold and physical silver, but I think there's going to be looming supply problems, especially on the mining side. People aren't talking about this right now, but I think there's going to be very big supply problems in the next couple of years unless the prices start to rise, because the miners just, whether it's a miner that produces silver as byproduct or a primary silver miner, they just can't come up with new ways to cut costs to keep themselves afloat anymore.
Yeah, and again, in conclusion, this is how peak oil and peak metals and peak silver occurs. This is how it happens. It happens because the market can't afford to pay for higher copper prices. And what I didn't realize as well, when we had higher oil prices, by adding a lot of debt, because people need to realize this, and we'll conclude here. I know we've gone over a little bit, but when you see all that debt, wherever it is, U.S. government debt, whether it's U.K. debt, Canadian debt, corporate debt, wherever this debt is, think of it as it's basically what the public can't afford to pay for energy. And that's a little bit oversimplified, but that's what it is. We have stole energy from the future because we couldn't afford it. So we use debt to make it affordable. And so now higher oil prices allowed higher copper price. Higher copper prices allowed more copper production. So what we're seeing now is we are witnessing peak oil and peak metals production. It's happening right now. And nothing happens in one day, but I think what we're starting to witness is that we couldn't have high copper prices if we didn't have high debt. So what will the world be able to afford without all this debt and all this propping up by the Fed and central banks and negative interest rates? I don't know. It'll be interesting to see, but to me, if you're going to be investing in something, I would not be in dollars, treasuries, stocks, or bonds. It would be something physical assets, and that's not even real estate, because as you know, if you only have half the energy that you're normally used to, what is that going to do to real estate prices? So real estate won't be the go-to asset either. So I think investors are going to get a huge wake-up call over the next several years, and there's going to be a big adjustment of what is real assets and what are not. And so I think that's the key. What are real assets and what are not, or let's say liabilities? I think we're going to see assets turn into liabilities.
Yep. Especially if people are, buying real estate on debt, and things like that. So, yeah, we're gonna see people's cash flows are dropping. Asset prices may start to fall. We've already seen this in commodities. We haven't seen this in stocks recently, or in or in bond prices, in government bond prices recently, especially in the developed world. But we're going to see asset prices at least temporarily fall before the central banks, especially the Federal Reserve, start the next money printing program, which could create hyperinflation or stagflation, or worsening stagflation or things like that. But thank you again, Steve, for your time, and I really enjoyed this discussion.
Me too, Jason. Thank you very much.